When evaluating a high-performance vehicle, engineers look at two entirely separate metrics. On one side, they measure the raw internal horsepower of the engine. On the other, they track the physical position of the car as it navigates the rigid boundaries of a racetrack. In financial markets, we use a similar dual mandate to evaluate price momentum. The Relative Strength Index, or RSI, acts as our engine dynamometer, measuring the internal strength of buying and selling pressure. The stochastic oscillator, meanwhile, maps the car on the track, tracking where the current price sits relative to its recent historical boundaries. This chart shows a standard sequence of price action. Both RSI and stochastics are plotted below, and both are mathematically bounded between 0 and 100. Yet right here, RSI generates a clear buy signal, while the stochastic indicator simultaneously flashes a strict command to sell. This exact contradiction traps traders daily. They treat these tools as interchangeable predictive oracles, expecting them to spit out a universal consensus on where the market is headed next. Relying on standard labels like overbought and oversold without understanding the underlying math is the primary cause of these conflicting signals. To resolve them, we have to look under the hood. To resolve these conflicting outputs, we need to abandon retail trading assumptions and rebuild both indicators from scratch. Every technical indicator processes the exact same raw materials, the opening, highest, lowest, and closing prices of a specific time period. RSI and stochastics take those identical 4 data points and run them through entirely separate equations. By tearing down those equations, we can isolate exactly what data each indicator prioritizes and prove mathematically which market environments they are engineered to navigate. We start with the math behind the Relative Strength Index. The entire indicator is driven by one core variable, the RS component. RS stands for relative strength. To calculate it, you divide the average gain over a set period by the average loss over that same period. If recent price gains consistently outsize the losses, the math tips heavily in one direction. As those positive closing values stack up, the underlying value forces the RSI line aggressively upward toward the 100 ceiling. Notice what is missing from this equation. RSI does not factor in the absolute height of the current price. It only calculates the velocity and consistency of the internal buying pressure. This ratio determines the midpoint of the scale. When average gains equal average losses, the equation results in an RS of 1, which balances the RSI at exactly 50. Sustaining above this equilibrium confirms that structural bullish momentum is in control, regardless of how high the chart appears visually. RSI is purely a diagnostic test of the market's engine. It validates whether a directional move actually has the horsepower required to sustain a trend. The stochastic oscillator takes a completely different approach. Its core metric, known as %K, does not measure velocity. It measures spatial positioning. Looking at this price chart, the stochastics formula scans a specific historical window and identifies the absolute highest high and lowest low, creating a strict bounding box around recent price action. The indicator then takes the current closing price and maps exactly where it lands inside that historical box. If price closes near the very top of its recent range, the %K line pins near 100. To filter out market noise, the equation adds a second, smoothed line called %D, which is simply a moving average of that reactive %K metric. When the fast %K line crosses the slower %D line near the extreme top or bottom limits of that box, it generates an actionable signal. Stochastics do not measure internal momentum power. They measure spatial exhaustion, answering a very specific question. Is the asset physically stretched too far against its own recent boundaries? The most precise signal generated by either of these tools occurs when the mathematical calculation actively contradicts the visual price trend. This classification matrix details what analysts call divergence. It serves as an early warning system for a coming trend reversal. Let's isolate Class A bearish divergence in the top right. Here, the visual price chart pushes upward to make a higher high, but the mathematical oscillator simultaneously begins printing lower highs. The physics here are clear. The asset is still technically climbing the hill, but the internal velocity measured by RSI, or the range-pushing capability measured by stochastics, is rapidly decaying. The engine is failing before the car stops rolling. Divergence demonstrates that standard threshold crosses are secondary. The signal reveals when the internal momentum of a move has already shifted. even as the visual price trend continues to climb. This brings us to the mechanical error that leads to repeated false signals, selling an asset the moment an oscillator crosses the 70 level into so-called overbought territory. In a strong, sustained uptrend, an asset's internal power will logically remain elevated. That intense buying pressure will pin the RSI line above 70 for extended periods. Selling here means stepping directly in front of a freight train. The operational rule is simple. RSI is built to evaluate trends. It is used to confirm the power of breakouts and validate sustained directional moves. Stochastics, however, are hypersensitive to boundaries. That makes them highly effective in consolidated sideways markets to pinpoint exhaustion entries. Deploying a range-bound tool in a trending market or a trend tool in a sideways market is the root cause of the false signal epidemic. Context must always dictate the tool. Technical indicators do not predict the future. They strictly translate raw data into specific momentum and spatial parameters. Ask the RSI, is the current move powerful? Ask the stochastic oscillator, is the price at the extreme top or bottom of its box? High probability trading is achieved not by memorizing signals, but by matching the mathematical architecture of the indicator to the structural reality of the market.